welcome to our analyst call for Castrol India Limited 1Q 2023 financial results. Please note that all participant lines will be in the listen-only mode, and you can ask your questions after the opening statements. If you need assistance during the call, please press star then 0 on your touchtone phone to reach the operator. We have with us Mr. Sandeep Sangwan, Managing Director, Castrol India Limited, and Mr. Dipesh Bakshi, CFO and Whole-Time Director, Castrol India Limited. I now hand over the conference to Mr. Sangwan. Thank you, and over to you, sir.
Thank you very much. Good afternoon, everyone, and thank you for attending Castrol India's first quarter 23 earnings call. I hope you and your family are doing well. And just to remind you that we have our financial year from Jan to December, and that's why we call this our quarter one earnings call. And I'm very pleased to share that Castrol India Limited delivered resilient performance in the first quarter of 23, and through our session today, we'll talk more in detail. We built good growth momentum from fourth quarter 22 and registered quarter-on-quarter growth in first quarter of 23. Our performance versus the first quarter of last year was impacted due to inflationary pressures, high input costs, and fluctuating forex. But I'm very positive as we go through the rest of the year and with the momentum that we're seeing. And to begin, I'll invite Dipesh, our CFO, to talk you through our first quarter numbers and financial performance in detail.
Thanks, Sandeep, and good afternoon to all of you. We announced our first quarter 2023 results last evening, and here are some of the key financial highlights. In 1Q 2023, we reported a strong financial performance. Our revenue from operations was 1,294 crores, and this is up by 10% compared to 1,176 crores in 4Q of 2022. That number is also when we compare to 1Q 2022, last year's first quarter, is up by 5% from 1,236 crores. Profit before tax was 288 crores, which is higher by 16% compared to the sequential quarter of 4Q 2022, and lower by 7%, 311 crores versus 1Q 2022. Overall, we remain confident of our strong business fundamentals and long-term profitable growth in India. I would now like to hand over back to Sandeep.
Thanks, Dipesh. Apart from the financial performance, I'd like to draw your attention to some key business developments at Castrol India. First, we expanded our presence in service and maintenance space, increasing our Castrol Auto Service outlets to over 300 across about 100 cities in India. And we have 5,000 Castrol bike points across India. We will continue to drive consistent growth in the subsequent quarters and enhance our industry partnerships to ramp up our service and maintenance offerings and new strategic segments such as automotive aftercare. On 28th of February, Castrol also unveiled its refreshed brand identity globally, including an updated look and feel. The brand refresh with the theme of onward, upward, and forward is aimed at better reflecting its unique positioning in the market and the opportunities it sees in meeting the changing needs of customers. Castrol India also collaborated with JioCinema for streaming the 2023 Tata Indian Premier League IPL as an associate sponsor. The partnership aimed to engage with cricket fans across India and leverage the platform to showcase Castrol's refreshed brand identity. With this association, Castrol continues its long legacy of sponsoring some of the world's largest and most significant sporting events over the years. Castrol Super Mechanic Contest won the Best Branded Content category award at the prestigious Asia Pacific Festival of Media Awards. Please note, Castrol India Limited will hold its 45th annual general meeting for shareholders on 11th May of 2023. We've also taken actions on sustainability especially around plastic waste reduction. So, for example, by March of this year, we've collected 100% of our plastic that goes into the market, which is ahead of the regulatory requirements, and we're very seriously looking at other opportunities to reduce plastic in our packaging, using renewable energy in our plants. So a lot of initiatives around sustainability as well to make sure that we stay in line with our overall objective of reducing waste, improving energy efficiency, and reducing plastic. With that, I'd like to thank you for your attention and would like to open the session for your questions, feedback, and views, please. Faizan, over to you we can start the questions.
Thank you, Mr. Sangwan and Mr. Bakshi. We will now begin the question and answer session. If you wish to ask a question, please press star and 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, please press star and 2. Participants are requested to use handsets while asking a question. Also, in lieu of the time, we will stick to 2 questions per person. If you have further questions, kindly rejoin the question queue. Ladies and gentlemen, let us wait for a moment while the questions come in. The first question is from the line of Bhagyesh Kagalkar from HDFC Mutual Fund. Please go ahead.
Yeah. Hi, sir. This is Bhagyesh. So I have a couple of queries on the new initiative area. First of all, the annual report has come out, and the good thing is there is substantial backing to us from BP Group, which is also far ahead in the charging or even in other EV areas, and we should benefit from this thing logically. But the whole issue here is, sir, company needs to lay a roadmap for next 3 to 5 years, basically. Where are the revenue potential as well as the profitability potential for the future areas? I'll just give an example of charging. So most of the charging facilities in India are very underutilized, hardly 3% in the EV space. So one needs to be slightly cautious and yet lay a roadmap for the future, for next 3 to 5 years.
So Bhagyesh, thanks. Excellent question. Very insightful. We have a very clear roadmap for the next 3 to 5 years. And the first point I'd like to say is our core business, which is built around lubricants, will continue to stay very robust for the next 3 to 5 years. We're seeing more than 20% growth in the car category, given the low penetration in India of passenger cars. And I'm talking internal combustion engine, ICE cars here, EVs. Two-wheelers still continue to grow, although the electrification will come much faster in two-wheelers, and commercial vehicle and agricultural sector continue to grow. So the underlying lubricants business and related fluids will continue to stay very robust for the next, in fact, going well into the 2040s. Okay, so that's one thing I'd like to say. And Castrol always tries to grow slightly ahead of the market in this space. That's point number 1. The second is, as I said, the second building block is our service and maintenance or the workshop business, okay, where we're making headway in growth with our own network, which is 300 plus strong of Castrol Auto Service, which service cars, and 5,000 bike points, so giving a trusted quality service to consumers. Okay. And last year we had announced our investment in Key Mobility Solutions, which is a unique digital business model, again playing in the aftermarket. So that's the second leg of our growth. And the third leg of our growth is we are entering into adjacencies. For example, over the last 2 years we've piloted auto care range, and this year, within this quarter, in fact, we'll be making that as a national launch going forward. So I think our next 3 to 5 years roadmap, as you're requesting, is very clear in terms of where we want to grow and how we want to grow. EV charging, you rightly said, is still a very nascent area, and BP's partner company, which is GeoBP, is looking at that opportunity. And if we can add any value, we will add value to that with our large network of 100,000 outlets that we have across the country. So that's the broad shape of where we are headed.
Thanks for the answer, sir, and all the best. Thanks.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Nalin Shah from NVS Brokerage. Please go ahead.
Thank you for the opportunity. At the outset, let me just say the kind of confidence, sir, you have expressed in the future of Castrol is very, very, I think, welcome, and we really feel very confident about the performance of the company. My question is also more or less similar, that where do we see the company from here on for next 3 to 5 years in terms of, whatever you may say, top line or, like kind of a growth which is expected in terms of volume, in terms of value, etc. And where do we see the company from here in terms of this kind of growth which you outlined for 3 to 5 years? Because we need to have some kind of, understanding in terms of, the investment point of view.
Okay. So thank you, Mr. Shah, for your question. I think at the outset, let me say we typically don't give any guidance in terms of growth numbers and etc. But I'll give you a broad shape, and then I'll request the page to join in. Okay.
Yeah.
Category, if you look at the total lubricants category, that grows at about 3 to 5% in that broad range. Okay? And we don't see that changing significantly in the next 5 years or even longer at least. Okay. And our endeavor is to grow our volumes and top line ahead of the category by a few points. Okay.
Right.
The second is we will continue investing in our brand. Okay, one of the strengths is our brand, because we are a premium brand and will continue to be a premium brand. So investments behind our brands, and you would have seen in the numbers, will continue at a level that we've historically invested in. Okay, and we have capital investments that also go to support some of our initiatives, whether it is service and maintenance, independent workshops, etc. And then through cost efficiencies, if we can add another percentage or so, if you look at our this quarter's EBITDA, which is again back to 23%, which was 21% in Q4 last year, and I think we've said we'll operate in a band of 23 to 26%. So EBITDA margins will also continue to be operating in that frame. So hopefully that gives you a view of how we're looking at the next 3 to 5 years.
Yes, perfectly okay. But since the new initiatives are there, can we have some guidance, as you mentioned about the 3 to 5% growth in the lubricant business? So similarly, just can we have some idea about what kind of, considering the other new initiatives, what kind of a top line growth we can sort of project?
So I think on the new initiatives, to be honest, Mr. Shah, it's still early days. Okay, we have certain projections that I don't want to share on a call. But hopefully once we have 6 to 12 months of kind of performance under our belt, we'll be able to have a better view on how much that can add to the top line. But as you said, we are committed to kind of auto care category, okay, as one area. And the second is expanding our presence in independent workshops to begin with.
Thank you. Mr. Shah, may we request that you return to the question queue for follow-up questions? Thank you. We'll take the next question from the line of Pranay Gandhi from Green Portfolio. Please go ahead.
Hi, sir. Good afternoon. Yeah, I have a question regarding the after-sales service that we got into. Firstly, it's a commendable initiative the company is taking. But I would like to know what proportion of our sales come through these tie-ups in comparison to our conventional business.
So Pranay, thanks for asking that question. I think what I would say is almost about 80% of our revenue comes from automotive, space, and primarily we are an aftermarket company. Our OEM business component is small as compared to the overall business. And we play in the aftermarket because that's the strength of the brand, where we can get the premiums and the pricing that we can demand. Now, from the tie-ups, I think Key Mobility is just getting into execution phase, but they have a good coverage of garages, retailers, and I think we'll start seeing the momentum on that area. Independent workshops is another big component in our mobility space, which accounts for a good percentage of our sales in two-wheelers and four-wheelers category. So overall, I would say just keep the frame of automotive about 80% of our business and primarily coming from the aftermarket. That's how we kind of, more than that, I don't want to be very granular. And Dipesh, if you want to add anything, please come in. So.
Thank you for answering that, sir. My only concern here was that since we are tying up with independent workshops and training them, so does it add on to the margins or probably our sales volume exponentially, or we are still somewhat in a similar range as we were previously than taking these initiatives?
No, so I think possibly will be in the similar range, plus minus. But I think what is happening is, as vehicles get more sophisticated, okay, and the engines get more sophisticated, both in four-wheelers and two-wheelers, that gives us an opportunity to upgrade the portfolio. Okay, so from viscosities like 20W, 10W, the market is moving to more 5Ws and 0Ws, okay, which is better products, thinner oils, and where Castrol has good advantage in terms of technology, because we can leverage our European R&D centers. So there will be an upgrading opportunity as the category shifts. But overall, the trends would be pretty similar, because workshops, the only shift we're seeing is the demand in passenger cars seems to be shifting from retail to workshops now. I think that's one trend that we are observing.
Okay. Thank you, sir. And what about the margins? Do we command higher margins with our own tires, or, for example, Key Mobility as well, since we would have access to their spare parts, which we could supply to our own tire workshop? Apart from that, even the lubricants, do we earn a higher margin in our own workshop or the workshops with which we have tires in comparison to the market in general?
So, Pranay, our margins are pretty similar, whether we work with partners such as Key Mobility or whether we work in our workshops. The advantage we get with partners such as Key Mobility is they operate under the brand of MyTVS, and they are a much more digitally focused business. So we get synergies on a brand level, plus we get additional access opportunity for incremental volume and incremental business. But the margin structures are pretty similar, and we want to protect our margins whether we work in partners or whether we work in our own workshops.
Thank you. Mr. Gandhi, may we request that you return to the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. We'll take the next question from the line of Mohit Mehra from Guardian Capital. Please go ahead.
Thank you for this opportunity. The first one is a bookkeeping question. How much was the
interrupt you. The audio is unclear from your line. Please use the handset mode.
Can you hear me now?
Yes, we can.
Okay, so the first question is a bookkeeping question. What was the volume during the quarter?
Sorry, we couldn't hear you. What is the volume for the first?
What is the volume number?
Oh, okay. All right. Sorry, I thought there was a further following question. Volume was about 55 million liters.
Okay. And secondly, how much inventory of logs and additives do you maintain? Because if I look on a YOY basis, crude price has actually declined. And even in your opening comments as well as in the press release, it said that because of inflationary pressures, the margin had declined on a year-on-year basis.
Yeah. So let me just explain this in a little bit more detail. So direct linkage with crude oil is probably not a fair assumption. Reason being that crude oil to base oil and then from base oil to additives, when the manufacturers do, there is a lag, right? And then from the time base oil comes into our tanks to the time it gets manufactured also and then sits in the inventory, there is a lag. But having said that, typically we would have inventory which range between about 25 to 40 days, depending on the raw material or finished goods. Yeah, that's one. Second is one ability that we have, which we do pretty well, is managing this working capital cycle and doing shifts between local buy and international buy to both leverage the costs as well as manage inventory. So to give you an example, currently, while crude oil is going down and the base oil is also softening, our inventory at March is on the higher side from the range that I given, to make sure that it's on a lower side, because we have made sure that when we buy, we do a bit of a buy later on, so that the inventory is lower, and therefore we don't get blocked into the working capital. So that's the process we adopt. Coming back to your question directly, it's in the range of 30 to 45 days.
Got it. And there is no inventory revaluation that happens, right? So everything is recorded on as price paid, right? So because the OMCs, for instance, they have inventory revaluation, that causes a lot of fluctuation in earnings.
No. We don't. Our accounting system, if you look at our policy, in the accounts, it is a weighted average cost. So I don't know if you're asking whether there is a mark to market. No, we don't have mark to market.
Okay. Yeah, that's what I asked. Thank you.
Okay, thank you.
Thank you. The next question is from the line of Abhijit Bora from Sharekhan by BNP Paribas. Please go ahead.
Can you give the base oil prices currently and what was in the previous quarter?
I think the base oil range was about 1,000 to 1,100 in the previous quarter, and towards the end of the quarter it went towards 1,000, and I'm giving you the external benchmarking that is there and available. And in this quarter it's gone down by about $100.
Okay, so it is close to around 900 currently.
Around 900, 950, yeah.
Okay, and when we expect this benefit to flow in to our numbers, given the inventory buildup we have?
So the way we look at the benefit coming through is it's a combination of benefit coming through to us from a P&L perspective, or can we pass on some of that benefit to consumers and customers, because we have a pricing strategy, we have a framework that we operate in. So it's a combination of kind of that benefit being passed through to the market, but also kind of helping our P&L. That's how we kind of manage the fluctuations in the price.
Okay. Thank you, sir. That's all from my side.
Thank you.
Thank you. The next question is from the line of Pratik Banthia from Girik Capital. Please go ahead.
Hello?
Yes, please.
The line for the current participant has got disconnected. We'll move on to the next question from the line of Bharat Sheth from Quest Investment Advisors. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, if we bifurcate a ballpark figure, that how much our current sales is generated through this synthetic oil, where this base oil has a very minimal use, and how much is from the products which are purely a base oil base?
So first of all, let me kind of just correct one statement. Synthetics also use base oil, but they use a higher quality base oil. Okay, there are different grades of base oil. So synthetic products also use a higher quality base oil. First of all, so it's not that they don't use any base oil.
But is that fair understanding the content is comparatively lower?
Not really. Okay, I don't want to get into specific technology, but they also use similar level of content, but of a much higher quality versus non-synthetic or monograde products. Yeah, and if you look at about 10 to 11% of our sales comes from synthetic products.
How are we seeing the traction of that business? Because that's having a long drain.
Yeah, so long drain definitely kind of impacts the frequency of oil changes, but that gets compensated through better quality of products where we can charge a premium. So it almost kind of plays out, and that's why the category itself continues to grow at about between 3 to 5% on a per annum basis.
And last question, sir, our base oil, how is the availability domestic vis-a-vis global? Because what we understand, our Indian refiner largely are remaining away from producing base oil. So if you can give some industry perspective on that.
Yeah, sure. So I think if I give you the present scenario, I don't think there is a problem, frankly, on the availability locally or internationally, and that obviously is translating into the softening of the base oil. Yeah, I think what we do is, while we have, which is an advantage to us, while we have global contracts, right, negotiated globally, we do get price advantage, and the certain component of our purchases is through global, and therefore imports. Of course, we get exposed to some forex risk, but the trade-off is pretty good in that sense. And then we, as I was mentioning earlier, we use tactically to buy locally in terms of making sure, depending on the price of base oil is going up or down, to manage our inventory and work that through. In case there is a supply constraint, then also we have that lever available to import versus domestic buy. But if I were to generalize the response, the availability is not a problem right now.
And also this decline is bulk shipping rate has helped us in any way reducing our cost?
So let me understand your question. Your question is
during post-COVID, immediately the freight rate has gone up. Of course, largely it was container, but bulk was still, but it has also moved up significantly than what was the remaining average.
Yeah, so there is softening on that as well. So there is benefit we can see there as well, if that's what you're asking.
Yeah. Thank you very much, sir, and all the best.
Thank you very much.
Thank you. The next question is from the line of Shalabh Agarwal from Snowball Capital Investment Advisors. Please go ahead. Mr. Agarwal, your line is in talk mode.
Hello.
Go ahead with your question.
Hello, am I audible?
Yeah, we can hear you, sir.
Oh, good afternoon, sir, and thank you for giving this opportunity. So the first question is on the overall volume growth that we registered for the last year. I think it was very flattish from the previous year. See if you can give us some understanding of how the market moved, last calendar year, and how we performed across different categories, where we were ahead. If in personal mobility, if we were ahead, if you can give some color around that.
Yeah, so I think you're right. The last year volume was flattish, and I think last year was a story of two halves. We had very good volume momentum in the first quarter, and then because of the inflationary pressures, it started softening a bit. And second half, from a volume perspective, was soft, whereas on turnover, because of pricing, the turnover was pretty fine. Now, in terms of share position, I wouldn't like to kind of give specific numbers, but we've grown our share over the last few months in passenger cars. I think the shares have been a bit soft on two-wheelers. Okay, and we've more or less held our shares in commercial vehicles and in agricultural sector. And I think looking forward to this year, we see the category still at about 3 to 5% growth rate. Okay, and I shared some numbers earlier in terms of the spaces might be slightly different. So that's the broad kind of position where we are.
But so would it be correct to say that probably personal mobility, which is both cars and two-wheelers, grew in high single digits or close to double digits for us last calendar year in volume?
Yes, you're right. Passenger cars grew in high double digits, in mid to high double digits. I think two-wheelers was high single digits. Okay, that's what. And then we had some pressures on commercial vehicles and agricultural sector second half. Okay, and industrial volumes were also a bit kind of softer.
Okay, that is helpful, sir. So second question is because there have been repeated concerns given the uptick in the EV space in India. Would like to ask, in case you can share some insights from your Chinese market, given Castrol is also a big player over there, and the EV penetration is much higher both in two-wheelers and four-wheelers. How is the engine oil volume growth been in China, given Castrol is a much bigger player? If you can share some insights, that will be helpful.
Yeah, so I think first of all, we are very active in the electrification or EV fluids, both globally and in China. And almost 50% of the global OEMs use Castrol EV fluids in one way or the other. And in India also, we supply to two of the largest EV players in the passenger car market, which is Tata and MG Motors, and we have supply positions with them. The second is, I think in India, the electrification is not going to be as fast as in China. We expect the pace of electrification, it will happen in India, but I think the lubricants market will continue growing well into the 2040s, where in China, the pace of electrification is much faster. And I think what our learning has been in China, that we engage with the OEMs early in the process in terms of making sure that we are also helping them with the development of EV fluids in their vehicles. So, for example, we work with many of the Chinese OEMs like BYD, Shanghai Automotive, and we work with them on EV side as well. So that's the broad learning. I think China, the two-wheeler market electrified many years ago. Okay, so two-wheeler comparison is not relevant as far as China is concerned, because there it was more like moped kind of users of two-wheelers rather than motorcycles or scooters as we see in India.
Thank you. Mr. Agarwal, may we request that you return to the question queue for follow-up questions. Ladies and gentlemen, this is bring to your notice that the call will conclude in the next 15 minutes. Thank you. The next question is from the line of Pratik Banthia from Girik Capital. Please go ahead.
Hello?
Yes,
Mr. Bhatia. Yeah, hi. Hello, sir. Sir, my question is on the service business, which we are planning to expand. Sir, how do you see this as an opportunity, given there are not many organized service centers, and given the Castrol's brand name? How do you plan to leverage this? Given there's a lot of money in this business, so what is the way forward for us?
So I think the way forward for us is, Mr. Bhatia, first of all, is to create a network where consumers or customers can get consistent quality service. Because one of the issues we have, consumers have, is they don't trust the independent auto aftermarket in terms of getting a reliable service.
Yes.
And having that network helps us, first of all, making sure that the consumers are getting genuine products, genuine Castrol lubricants for their engines, which are right for their vehicles. The second is we train these workshops. We certify them through standard operating procedures. We have a tie-up with the certification agency. So right now the intent is to create that ecosystem in India, as you rightly said. With my TVS and Castrol, possibly we will be able to create one of the largest aftermarket ecosystems around service and maintenance.
Got it, sir. Yeah. So in this will be kind of the customers will be coming to Castrol service outlets after that. Their 3-year warranty is over. What the OEM gives.
Yeah.
Yes. So here we would also need parts, auto parts, there's a replacement or something like that. So then, how would we take care of the availability of parts? Will we be doing some some sort of tie-up with the OEMs for the genuine parts, or how would that work?
So, excellent question, and I think that was one of the key reasons why we made the investment in Key Mobility Solutions, which is part of the TVS Group, because Key Mobility has a legacy or existing very strong spare parts business. And right now we are integrating that spare parts availability or respecting competition law. We're going to make that spare parts availability for our Castrol Auto Services and bike points. So that's why we invested in that company, because that gave us something that we were missing.
Thank you, Mr. Bante. May we request that you return to the question queue for follow-up questions? We'll take the next question from the line of Harsh Maru from Emkay Global Financial Services. Please go ahead.
Thank you for the opportunity, sir. So my first question is around the volumes. So if you look at the last 3 years, which is first quarter of 21, 22 and 23, there was a surge in terms of volume. So Q1 saw about 60.5 million liters. Q1 22 was again about 59 million liters, and Q1 of 23 is also about 55 million liters. So sequentially, do we see some seasonality in the business over here? So if you would throw some color on that,
Yeah, I think it's not a question of seasonality. I think if you remember 21, we were coming out of the COVID first wave. First wave kind of which started and the country was shut down. And I think when we opened up in the beginning of 21, so there was a surge of demand in all services. And I think all the companies had very good first quarter in 21. Similarly, last year, again, the second wave hit around in 21, and then first quarter of 22, we were coming out of that softer second half, second wave impact of COVID. So I think I won't call it seasonality. I think the whole environmental situation has been very unique over the last 2-3 years. And what I'd like to say is, I think for these years, we should look at the performance on a total year basis, and as a company, we are very satisfied the way we manage. So even if you look at our bottom line profits, while the page can talk exact numbers, we had a profit PBT about 700 plus crores in 20, we increased it to 1,020 crores, and despite huge inflationary challenges last year, we delivered a profit of 1,090 crores approximately. So I think don't read too much into that from a seasonality perspective. I think now with situation becoming normal and inflationary pressures easing, like last year, last quarter, our volume was in the range of 48, 49, and this quarter we've delivered 55 million liters. So we are quite positive on the momentum. By quarter, we see some seasonality, which comes from the agricultural business.
Right. And just one more question. So if you were to look at the additive costs over the last, say, 3 to 4 years, and if you were to put a base of about 100, could you say that how the prices have moved, say, in 2020, say the prices rose 30%, went to a 130 base. So if you could give us some ballpark numbers around the trend in additive costs.
Yeah, no, thanks. This is something we are closely monitoring. So I would say the additive cost, if you say 2020 and 21 beginning was 100, today it is almost 150, 160. That's the amount of unprecedented rise that we have seen in additives.
Thank you, Mr. Maru. May we request that you return to the question queue for follow-up questions? Ladies and gentlemen, this is bring to your notice that the call will conclude in the next 5 minutes. Thank you. We'll take the next question from the line of Mohit Mehra from Guardian Capital. Please go ahead.
I wanted to know how you guys think about margin, because in this quarter, if you look at the RM cost per liter, that has come off significantly, but the gross contribution per liter, that is more or less flat. So in fact, it is very slightly lower. So should we just stick by that EBITDA margin guidance in terms of percentage that you're, or do you have to look at this per liter contribution?
So I think we do look at per liter contribution. We look at all the lines of P&L, but I think as far as overall as our frame is that we want to be in that range of EBITDA guidance. Okay, then that's how we manage our P&L. I wouldn't like to get into per liter contribution, etc. We've shared our volume numbers. You can estimate what it is, but our intent is to manage the EBITDA margin within a band, sir.
Got it. But then let's say if crude were to decline to $60 per barrel on absolute basis, our EBITDA in rupees million, that could decline, right?
No, crude if declines, then we get the benefit because then input cost will decline, oil will decline, therefore cost of goods decline. But remember, we also want to focus on giving the right value to our customers and want to make sure that we are contributing and investing in our brands. So obviously it is not a straight flow through, right? The corresponding is also true, which is every time crude keeps going up, you just can't take price increases in the market in every part of the segment, right? For example, in retail might be easier than doing it in the B2B setup. Does that help? Yeah. But as Sandeep said, I think the way we look at our P&L is definitely at a gross profit level, clearly, and endeavor is to maintain margin. Clearly, we don't want to go and have a disproportionate increase. But having said that, because costs are increasing, inflation in India is high. So what we are saying is we need a bit of a flex on the EBITDA margin, some elbow room, and the range when we try to operate is something between 23 to 25%. So you will see some quarters where it will go to 25, some quarters you will see going to 23, 22. And that range and band is what we want to work for, because then that helps do the right decisions for the business rather than, just reacting in a tactical manner to the decrease in the input cost. Therefore, pricing also we are very strategic. We don't take tactical pricing.
Okay. Got it. Thank you.
Okay, thank you.
Thank you. The next question is from the line of Shalabh Agarwal from Snowball Capital Investment Advisors. Please go ahead. Mr. Agarwal.
So thank you for giving this. Yeah, thank you for giving this opportunity again. So circling back on my earlier question on the Chinese market, I was more interested in knowing about the ICE engine oil demand. How has it been in China last couple of years, given the EV penetration?
Yeah, so Shalabh, I think it'll be wrong for me to comment on China because I'm not very close to that business. My focus is making sure that we continue winning with Castrol in India. Okay, maybe we can connect offline and we can share something with you. So
sure, sir. And so just lastly, for this quarter, again in the personal mobility, would we have grown by in mid-single digits? Would that be a correct assessment?
So I think for the quarter I won't share, but we've grown in cars while our two-wheelers has been more flattish, let's say. Yeah.
Okay. Thank you, sir, and all the very best.
Thank you. Thanks, Shalabh.
Thank you. The next question is from the line of Pratik Banthia from Girik Capital. Please go ahead.
Yeah, thank you, sir, for the follow-up question. So the other question I had was that are we targeting the cars in the mass market segment, or it will also be catering to the premium segment as well?
So we operate across segments, okay, and thankfully cars is not a category where a local unorganized sector play can happen. So most are very reputed companies and organizations which OEMs which get into the car space. And that gives us an opportunity to play across segments in the car space. So for example, we have a brand called Magnatech which plays on the premium end, and we have a brand called GTX which plays on the lower end of the market. But the endeavor is to service all needs of the car market at different price points, at different engine specifications, different viscosity specifications.
Got it, sir. And so last question, again on the service side, given we are expanding, So, the setup cost of a service center is different, if for a city like Mumbai versus rest of India, because of the real estate cost and the rent associated with that. So, so it will be our franchisee agreement or it will be company-owned, company-operated? How would that be?
So, a very good question. We don't have any company-owned, company-operated sites, and that is not the intent. We provide branding support because our brand draws consumers into the workshop, given the trust that consumers have on Castrol as a brand, and then we provide them training support and other support. But it's not an owned asset by the company.
Thank you. Ladies and gentlemen, that was the last question for today. On behalf of Castrol India Limited, I thank you for joining this call. You may now disconnect your lines. We wish you a good day ahead. Thank you.
Thank you, everyone. Thank you.
Thank you.